Good morning, everybody. Welcome to this webinar where we're looking to just provide some information specific to the draft bills that SARS have issued recently. By way of introduction, my name is John Jones. I am a Director of International and Corporate Tax at RSM South Africa. Just in terms of a little bit of housekeeping, if you do have any questions that arise flowing from this webinar, please feel free to drop those in the chat. I'm not going to be able to respond to those during the course of the webinar, but more than happy to do so post completion, and I will contact you and respond to any of those particular questions if you do have those. So just to kick in, and before we get into the draft bills, I just want to deal with a reminder, because I think this is something that people are going to forget about. And as we know, the tax rate change and assessed loss limitation rules have been amended accordingly. So just to deal with the corporate tax rate for years of assessment ending. So as we know, between 1 April 2022 and 30 March 2023, that's at 28%. And this wording is important for those years of assessment ending on or after 31 March 2023, it drops to 27%. And the CGT effective rate will reduce from 22.4% to 21.6%. This aspect is important in terms of that date, on or after 31 March 2023. The assessed loss limitation rules will begin to apply. And the impact of that is that we have a limitation on assessed losses carried forward from preceding years of assessment. This is a limitation which is limited to the higher of R1 million or 80% of taxable income, and as noted, is effective with the reduction in tax rate. Why this is important right now is please do not be caught by surprise. In particular, this may impact cash flows, because if your provisional taxes are falling within these periods, you may be in a position where you assumed you did not have tax payable because of assessed losses brought forward. But if you're in a taxable income position for this particular year of assessment, you need to consider these loss limitation rules quite carefully. So I just wanted to raise that as a point, just to keep everybody appraised of this. Please just don't be caught by surprise. Now to move to the draft tax bills. These were released on the 29th of July of 2022. There were 3 draft bills that were released for comment. The first of these, the Draft Tax Administration Laws Amendment Bill, which I'm going to refer to as Talab. The second, the Draft Taxation Laws Amendment Bill. And the third is the Draft Revenue Laws Amendment Bill. Please, important to keep in mind, these are only draft, so they have not been promulgated into law. So what we are looking at are proposals put out by the South African Revenue Services specific to certain potential amendments to these various acts. And these have been put out for comment. Once that comment is then received, that will be taken on board, and potentially some of these issues will be amended before the final bills are put in place. Keeping in mind also, as far as the webinar is concerned, is that I'm only dealing with certain aspects. It's not feasible to deal with every component of what has been inserted into these bills. So just to keep that in mind. So really what we're trying to do is be ahead of the game. So what are these about? So let's look at the Taxation Laws, Tax Administration Laws Amendment Bill. This really proposes changes across the board when we look at these various acts. So it looks at changes to the Transfer Duty Act, Estate Duty Act, Income Tax Act, Customs and Excise, Value Added, the Tax Administration Act, and the Employment Tax Incentive Act. But most of these changes are consequential. And what I mean by that is that we're really looking at minor wording changes that are just clarifying some aspects of these particular pieces of legislation. But there are a couple of main proposals. The first of which deals with Section 64M. Now, to the majority of us, this amendment in particular is not really going to impact, but I think it's still quite important to address. So Section 64 really deals with dividends and dividends withholdings taxes. And one of the requirements is particular to the application of a reduced rate of dividends withholdings tax. And what is required where a reduced rate of dividends withholdings tax is applicable, and normally this, for example, would apply in the case of a double taxation agreement, is that there is a declaration which is put in place and provided to the company declaring the dividend by the beneficial owner that the reduced rate is applicable. Excuse me. If the company declaring that dividend does not have this declaration in place, the company is required to apply the full rate of withholding at 20%. If the company is then subsequently provided with the declaration, then there is provision made for the company to recover from SARS that excess dividends withholdings tax that has been paid over. So just from an importance point of view, it's important for companies to understand that the application of the reduced rate requires the declaration. And if the declaration is not in place, you are obliged to apply the full 20%. What the legislation didn't deal with is the capability of what are referred to as regulated intermediaries to recover where the tax has been overpaid. So regulated intermediaries generally would kick in more commonly in the listed type environments where the company secretarial service providers will deal with the dividends withholdings taxes and pay those over. So they were not in a position where they could recover. So the amendment to Section 64M is intended to amend this to enable them to do so. But I think from my perspective, the most important thing is for everybody to understand that if you're looking to apply a reduced rate, you need to make sure the declaration is in place. Then we move to proposed amendments as far as VAT is concerned. And really the only one of any consequence deals with the removal of the requirement for electronic service providers to register where they have a supply in excess of R1 million. And obviously where you have a supply in excess of R1 million, you're obliged to register for VAT in South Africa. But if that supply is once off or temporary and you are an electronic service provider, then that obligation to register is removed. Employment tax incentive. Again, this really arises from the fact that what SARS has identified is a great deal of fraud in terms of the employment tax incentive environment. And they are now proposing that the standard understatement penalties will apply on ETI reimbursements where those have been claimed incorrectly or improperly. What this proposal doesn't deal with, though, is the fact that in terms of the ETI Act, there is already a potential penalty which can be imposed, which is a 100% penalty. So if they apply this proposed understatement penalty provision the way that they've put forward, then potentially there would be a double penalty exposure because you could be attacked on the understatement penalty in terms of the Tax Administration Act, but at the same time, a penalty could be imposed in terms of the ETI Act. So this doesn't make sense. That's something that will need to be addressed in terms of the final legislation. Then tax clearance certificates. I think the bane of everybody's life, but they are a reality. And what has historically and commonly been happening is that in order to obtain tax compliance status, and when you look at the tax compliance status and it's noted that there are tax returns or VAT returns or payroll returns which potentially have not been filed, taxpayers will file null returns or incorrect returns quite simply in order to obtain that tax compliance status, and then subsequently look to file revised returns in order to rectify the factual position. Now, what SARS are proposing is that in order to prevent this type of behavior, that they can revoke third-party access to a taxpayer's tax compliance status if that status is questioned by SARS, specifically due to fraud, misrepresentation, or non-disclosure of material facts. And it is proposed that taxpayers will then have 10 days to respond prior to that access being revoked. What is very concerning about this from a practical point of view is that it's not clear as to what criteria SARS would apply in order to determine whether they should be questioning a taxpayer. It can be very subjective in terms of an analysis. The second aspect is that this will obviously cause time delays. Now, when taxpayers are in positions when they're trying to get tenders in, this starts to impact significantly on the business. Fundamentally, I suppose SARS's view is, well, you should be filing your tax returns on time and paying your relevant taxes when you're supposed to pay them. Therefore, this shouldn't be an issue. But in the real world, these realities do become issues. What I think from a tax practitioner perspective is important to understand, and is when you file null or incorrect returns, this is it's a false declaration. And there have been cases where tax practitioners have filed null returns or dormant returns in order to ensure that tax compliance status is in place. This has subsequently been picked up by SARS because they then filed revised returns in order to reflect the true status. And these tax practitioners have been prosecuted and they have been criminally prosecuted. So really, from an advisory point of view, if tax compliance status is not in place, the filing of null or incorrect returns is not really an option. And it's not one that should be followed by taxpayers and or tax practitioners. Next, we look at the Taxation Laws Amendment Bill. And this deals specifically with income tax, value-added tax, and carbon tax. This is the biggest of the three amendment bills. Just as a start off, the first issue that they deal with is in terms of Section 7 Cap B, which deals with variable remuneration. Now, variable remuneration is common, but in terms of 7 Cap B, it's deemed to accrue to an employee in the tax year that the amount is paid. It includes things like overtime pay, bonuses, commissions, travel allowances, unutilized leave pay, night shift or standby allowances, and subsistence allowances. So that's why I say variable remuneration is common. We come across these things every day. But the proposal is that the section will now be amended to include any remuneration that is determined based on units produced. What that means, nobody quite knows. But I think the intention is that where remuneration is linked to some form of specific output, that this will now potentially fall within the definition of variable remuneration and would need to be taxed accordingly. Excuse me. And then there is an additional amendment to the section so that the section will not be applicable where an amount is paid to a deceased employee. And the effective impact of that is that where someone passes away, the date of accrual is fixed to the date prior to the date of death in such cases. Then the issue of tax residency. And this is around the apportionment of the interest exemption and the CGT annual exclusions. And really what they're looking at here is where an individual ceases to be a tax resident. So they change tax residency away from South Africa. In such a case, the tax year for that individual is deemed to end on the date before the residency ceases. The subsequent years, so potentially that taxpayer still have South African source revenues, so they may well have a subsequent tax year as a non-resident, and that is regarded as starting on that day as a non-resident. So what you effectively have is the taxpayer has 2 years of assessment in the same period. But the interest exemption and CGT annual exclusions have no provision for apportionment, which means that you can then claim these exemptions in full twice in terms of the way that the legislation is currently worded. That's obviously assuming that you qualify for the exemptions. So the proposal is that provision will now be made for that interest exemption and CGT exclusion to be apportioned if the tax year of assessment is less than 12 months. The only real question around this is they focused on these two exemptions and exclusions. There are other exemptions and exclusions within the Income Tax Act, which may also or should potentially also be apportioned, but they don't seem to be dealing with that. The last point on this is that e-filing doesn't cater for the filing of 2 tax returns in a tax year. So the question is, how do you go about dealing with this type of scenario in any event from a practical perspective? And that's something that SARS needs to address in terms of the capabilities of the e-filing system. Next, we go to Provident funds. So around 1 March 2021, there were significant retirement reforms, which particularly required mandatory annuitization for Provident fund members. The effect of all of these reforms is really trying to create a uniform tax treatment across the various types of retirement funds. But there is an anomaly where a member of a Provident fund retires before the age of 55, and where that retirement is for reasons other than ill health, then currently the withdrawal is still taxed as a withdrawal benefit and not as a retirement benefit. Given those reforms on the 1st of March of 2021, that's no longer required. So the provision requiring this treatment is now going to be withdrawn. And then there is an additional amendment arising from an anomaly in the legislation, which was promulgated and put in place 1 March 2021, where you still could not dealing with contributions made to pension funds pre-1 March 2021, you couldn't do transfers on a tax neutral basis, and that anomaly is now going to be resolved. Then contributed tax capital, a very underestimated and misunderstood concept. But in principle, Contributed tax capital is a contribution made as consideration for a class of shares. If you want to look at it in general terms, it's normally made up of share capital and share premium, and then if reduced by any capital amounts that have been subsequently transferred back. This is really an important definition and concept, because where companies do capital reductions or share buybacks, it becomes important in the determination as to whether those buybacks or capital reductions are being effectively funded from contributed tax capital or alternatively from retained earnings, because the impact is whether or not these amounts constitute a repayment of capital or constitute a dividend. In 2021, SARS looked at this and were of the view that there was abuse taking place. Again, SARS love to use that terminology. But what they were picking up is that there were distributions being made, but the contributed tax capital reductions were only being made to certain shareholders. So in other words, distributions, whether multiple or single distributions, were being made to shareholders. And when those distributions were being made, what was being identified was that some shareholders, some of those distributions would go to a company, and therefore they would be exempt from dividends withholdings tax. Other distributions would be going to individuals. So what companies were doing is doing distributions, and they were cherry picking how those distributions were being made. If they were going to a company, it would come out of retained earnings. If they were going to individuals, it would come out of capital, and by doing so would avoid dividends tax. So they have proposed to amend the definition of CTC so that shareholders within the same class must now share equally in the allocation of CTC. So there has to be a proportionate allocation. And this allocation has to take place within a period of 91 days before or after the date of transfer. Otherwise, potentially the distribution becomes tainted and is considered to be a dividend. Debt forgiveness rules. The debt forgiveness rules are dealt with in terms of Section 19 and paragraph 12 cap A of the 8th schedule. Again, something we come across commonly. Where debt is forgiven, it often triggers recoupments or CGT implications. And the effect is that it taxes a benefit that results from a concessional compromise of debt. Whether that benefit is revenue or capital depends on what that debt was used for when the funds were received. Currently, the legislation, however, has a minor weakness. It's not one that I believe is significant, but allowance assets disposed of in a year of assessment prior to the year of the debt benefits are not specifically covered by the legislation. You need to account for the recoupment in the year the debt benefit arises. So with the section not dealing with earlier years of assessment, some of those recoupment calculations have not taken into account the fact that there have been assets previously disposed of. So the amendment will now require there is a full recoupment for assets disposed of in earlier years of assessment. The challenge around this really is in terms of the record keeping as to how you work out and pick up when, if, how this factually happened. Then there have been some other more general amendments that are more industry specific. So the amendments dealing with the impact of IFRS 17 on insurance contracts on short-term and long-term insurers. There are proposed amendments specific to assessed loss limitation rules and CapEx for mining operations, where they are dictating as to where the assessed loss restriction must be applied. Similarly, interest limitation rules and CapEx on mining operations there's some clarity in terms of how those limitation rules will be applied. And then the tax treatment of assets acquired in kind as a government grant. So government grants generally are tax exempt. There are then limitations on what you're able to deduct from an expenditure point of view. But when we look at Section 11E, which is the wear and tear provision that uses the concept of value, So it doesn't. So what that means is that if you look at something that is received as a government grant in kind, as an asset, you can place a value on that asset and then claim Section 11E wear and tear allowances. So the intention is that the section will be amended to exclude assets in kind so that you cannot make use of that benefit. Excuse me. Research and development tax incentive. This has to be pre-approved R&D by the Department of Science and Innovation. So an application has to be made in order to have this approved, and then you potentially qualify for the R&D tax incentive. This gives you a 150% deduction of expenditure incurred on research and development. Currently, there is a sunset date of 1 October 2022. That will now be extended until the 31st of December of 2023. This, fundamentally a welcome extension. R&D obviously encourages innovation. It encourages value creation, and these are all things that we need desperately within our current environment. Then some stuff on international tax, which is fairly complex and deals with the joys of controlled foreign companies, and specifically with regards to royalties, where so in the normal course, the net income of a CFC is calculated as if it is an SA resident. There is an exemption in terms of Section 10(1)L that exempts any royalty that accrues to a non-resident unless it is the income of a permanent establishment or an individual who's in South Africa for more than 183 days. The proposed amendment will deny CFCs the exemption for non-residents of SA sourced royalties, so those will need to be included. And then there is an amendment which deals with the deemed income from hybrid equity instruments excluded from the income of CFCs. Highly complex pieces of legislation. So just really, if you are in this space, you need to take specific advice around these issues. On VAT, the intention is that they're going to extend the definition of enterprise to include lease agreements between a foreign lessor and a SA lessee, specific to foreign parts for foreign-owned ships, aircraft, and rolling stock. And then specific to the registration of certain foreign suppliers. So what people tend to forget from a VAT point of view is the definition of enterprise requires registration whether or not there is a physical presence in South Africa. So you may well fall within this definition, even though you don't have any physical operations within the country, and that creates an obligation to register for VAT. There may be no obligation to register for anything else. This creates a lot of administrative issues for foreign entities. So there's a proposed amendment which will supposedly allow a resident, and the intention appears to be that this will be a resident subsidiary or branch of a foreign company, to register a single branch registration in respect of all non-resident holding companies. It's a really confusing piece of legislation. It makes absolutely no sense. So it'll be interesting to see how this develops over the next couple of months. Then there's an intention as far as pooling arrangements is concerned, not something common, but the amendment is really aimed at medical practices and medical practitioners. This will enable them to facilitate single VAT registrations. So for example, where you have a hospital, within that hospital, you have a number of medical practitioners who are operating separate business operations. And what these pooling arrangements will allow them to do is effectively to have a single VAT registration with single submissions covering all of the medical practitioners, medical practices, and the hospital operating within that particular space. And then there are some specific amendments dealing with the documentary evidence for repossessions. Carbon tax. Intention was this be introduced in a phased manner. Until the end of 2022, there were defined rate increases by inflation plus 2%, with intended inflation adjustments from 2023. South Africa has now committed to net zero emissions by 2050. and therefore it is proposed that they're going to ramp up the carbon price for carbon tax purposes. And the proposed increases are that for 2023 to 2025, this will be US $1, increasing to US $20 in 2026, and reaching at least US 30 per ton of CO2 emissions in 2030. These are massive increases. And the question is, firstly, why US dollar? Why link to the US dollar? We're in an environment where the currency is volatile, the economy is under stress, and it doesn't make sense to link these things to the US dollar exchange rate. So again, there has been some commentary and feedback given to SARS on this. We'll see what happens. But if you are in the carbon tax space, just keep an eye on this, because these potential changes could be very significant and impact significantly on your business. In Section 12, Cap L, this allows for a deduction of amounts equivalent to monetary values of actual energy efficiency savings. So it is an incentive allowance to try and achieve or incentivize entities to achieve energy savings. It does require a certificate of approval to be issued by the SA National Energy Department Institute, and again has a sunset clause, but this will now be extended to the 31st of December 2025. The only question around this is, well, why have a sunset clause if you've committed to 2050? It doesn't really make sense to stop the incentive at 2025. And then lastly, on the TLAB customs, they're going to be introducing something which attacks vaping in terms of a flat excise rate of R2.90 per milliliter, which will be applied to both nicotine and non-nicotine solutions. And then last but not least, the Revenue Laws Amendment Bill deals specifically with the two parts retirement system. As we know, we have various retirement fund vehicles within South Africa: provident funds, pension funds, retirement annuity funds. There has been this process of harmonization in terms of dealing with the tax treatment of contributions and measures to increase preservation. There are two major concerns from a South African environmental perspective. Firstly, there is a lack of preservation before retirement, particularly around pension and provident funds. Access can be obtained on termination of employment. And I think what's being seen in the marketplace is that there is an incentive to leave just so that you can obtain short-term access to these funds. And then secondary to that, we have financial distress, where we have households with assets in retirement funds, but they cannot access these in order to alleviate that financial stress. And that's obviously been exacerbated by the pleasures of COVID-19. So really what they're looking at is this two-part system, where you have a savings pot, which is accessible, a retirement pot, which is preserved until retirement. And from a tax perspective, what they will try to achieve is that you exempt the contributions and the growth, but tax the withdrawals and the benefits. Again, it's quite complex. I think as far as this particular system is concerned, from an RSM point of view, we just need to look at doing a specific webinar around this so that everybody understands not only how the system is intended to work or will work, but also how the tax implications around it will function. So I'm slightly over the time allocated. I realize that this was very quick. Some of these matters are extremely complex. So as noted, please, if you do have any questions, please feel free to address those to us either in the chat, or alternatively, you can contact us post this webinar via email, and we'll look to try and assist you where you can. But thank you very much for attending. Your time is greatly appreciated. Thank you and goodbye.